Mr. Davis, you say, among other things, that there's an acute cash vacuum that is swiftly going to crash upon us. But you also say that the GDP, the gross domestic product in the United States, is likely to have a downward spiral that we haven't seen since the 1930s. My question to you, sir, is if that happens, is the stock market ready for it? Has it discounted that possibility?
Well, thanks for having me, Tyler. And that's tough to answer. I mean, I think there may be volatility ahead. I mean, the market is increasingly, pricing in a pretty somber outlook. That this will have a finite end to it. So, but the drop is pernicious. It's eye-watering, even when you look further back in history. So, some of the policy responses we've seen have been helpful, the Federal Reserve and the CARES Act, but I think it's insufficient just given the headwinds we're currently facing.
Ron Insana, you can't really imagine what it would be like if we didn't have these maneuvers from the Treasury and Congress and from the Federal Reserve. But do you think that they're going to be enough to stabilize things? I mean, the amount of damage that is being done by the minute in the economy is really incalculable.
Yeah, it is in many ways, Tyler. I would agree. And when you look back across history, we've never seen an automatic shutdown of the economy like this. Even if you go back to the Depression, there was a buildup to the weakening of economic growth. The Depression occurred over a period of 3 years and reached its nadir in 1932 when the unemployment rate hit 25%. Here, we're likely to hit 15 or 20% in a matter of weeks, if not months, which is, again, something we've not seen. Now, having said that, the relief programs so far, and I've been reviewing some of them because I am a small businessman myself, seem to be quite reasonable, although I do expect they'll have to be extended. It's hard to imagine that they're going to be able to fill a multi-trillion-dollar hole in the economy in excess of the $2.2 trillion relief package that's been passed. And then there's also presumably another $4.5 trillion in lending facilities from the Federal Reserve still to come online. But one would assume that this is going to get extended for small businesses, the type of relief we've discussed. Unemployment insurance will be extended, and that hopefully will help mitigate some of this. But it will take a Herculean effort to really blunt the impact of what we know we're going to see.
Joe Davis, are you in the camp that believes that the return to something like normal is going to be swift, or are you in the camp that believes that maybe we're in for not just a quarter or 2 quarters, but maybe a much longer time where we bump along the bottom economically?
Yeah, Tyler, I'm not in the L camp, although I wish I had more confidence in it. I mean, to be honest, I think we will see, hoping the day will come when the virus really dissipates and, we can lift some of these containment measures. When that does, I think arithmetically we'll get a modest growth rate bounce. But I think we're at a vulnerable stage here. The next several weeks and months are critical because there's building solvency and credit issues. The economy ultimately needs cash, not credit. And so I think, as Ron said, I think that the assistance to small businesses is just going to need to be supersized. By my estimates, at least 10 million businesses may need some sort of support or assistance. So it's going to be a Herculean effort. I think what occurs and transpires over the next 2 months, I think will dictate the pace of the recovery.
I want to ask you both a final question, if I may. I'll start with you, Ron. As we've been talking over these past couple of months, people have been saying, well, at least this is not a financial crisis like 2007 to 2009. But what, Ron, is the possibility that this morphs into a financial crisis beyond this crisis of demand destruction?
Yeah, I think, Tyler, that might be somewhat optimistic on the parts of those who are suggesting this isn't yet a financial crisis. I mean, it's a biologic crisis. It is an economic crisis. And it has, to a certain extent, morphed into a financial crisis of sorts. Clearly, the banks are far better capitalized, and they are not the source of the problem as they were in 2008 and 9. However, having said that, when you see the number of levered loans, when you see the high yield market, which granted spreads have tightened of late, when you see the dislocation going on in credit, there are going to be some problems there that mirror a financial crisis, maybe not to the same extent that we saw in 2008 or 9, but it's going to ripple through the system.
Joe, I'll give you the last quick word on that question about whether this could morph into a financial crisis or may already be one.
Well, I think we're on the precipice of credit issues accelerating. I wouldn't say that it's a foregone conclusion, only because of in the next few weeks, the sort of response we may see from fiscal as well as monetary policymakers. We're in a critical juncture. I'd like to not completely close the door and say a crisis is a foregone conclusion, but the next several weeks and months are an important point.
Joe Davis of Vanguard, thanks very much. Ron Insana, always great to see you. Gentlemen, stay safe. Have a good weekend.